going to Miami. Let me see here.
Oh, they're playing
U.S.
Norway in Miami. That's where they are. Yeah.
Is it okay?
Yeah. Anyway, well, anyway, so it'd be exciting to watch the U.S. Game tonight. I'm excited to see that. Root for the boys. Hopefully they can stay in it. And yeah,
It's good. It's going to be Seattle. That's where
Seattle.
they're playing.
Okay.
Belgium is in Seattle.
Nice.
Yep.
Well, good luck to the boys tonight. Hopefully they pull one out. Cool. Well, getting into the markets here, it's having the fourth weekend was last week Friday was off, and it's we talked about this last week. The markets are kind of quiet in the summer, especially around the fourth, so there's not much happening. Obviously, we had the end of the quarter last week, end of the first half, end of the quarter, and so end of the quarter, a lot of things happen, rebalancing, stuff like that. So we'll see. I'm not I was up late watching the game last night, so don't have the actual numbers for the quarter. We'll get them on Friday, but yeah, overall a decent quarter. The markets did pretty well, and we're going to talk about some of that today in terms of some of the stuff going on. I did want to point out that let's see here. There's some of the things that I keep bringing up, and I want to bring up a chart here because I've been talking about it so much. But we've been talking about the impact of semiconductors on the returns so far this year of the indexes, especially the S&P 500. And one of the reasons for that impact is the weight in the index. So this is 95 to 2025 weighting in the S&P 500 of semiconductors. So if you notice here, it was really small in 95, and then it peaked up in 2000 or late 99, and that was peaking up at 8%, and now it's at 19.7%. Everything else, pretty much dropped off in the last few years. Now, in some ways, this is a chart crime, so I'm going to kind of talk this out. I'm just showing you because I want everybody to understand the impact. Now, it's somewhat of a whoop. That's weird. Oh, that's really weird. Okay, I'm gonna have to restart that. That's anyway. Moving on. So it's kind of a chart crime because if you look back in 95, there weren't a whole lot of semiconductors. It's not quite the same, right? Now, in the last few years, semiconductors, because of AI, has been driving everything. Now, there's two parts of this, and one is semiconductors, in many regards, are way overvalued, and because we've seen immediate impact, and everybody feels like we need to overdo it, we need to buy way more semiconductors than we have, and now they got overproduced. So the companies are doing really well because everybody's buying semiconductors. At some point, there's going to be a glut, and then it's going to go the other way, and the companies won't be doing as well. But they've been killing it, and the PE ratios and pretty much every other measure that you'd want to measure them by are off the charts. But most importantly, if you look at the performance of semiconductors in the last few years, what you'll notice is pretty much April 1st, or when the quote unquote the war ended the first time, the semiconductors started to take off, and they did really well. And in the technology sector, it was mostly semis. Software stocks did not do well, but some other stocks, was mostly semis, did extremely well, especially as you can see here. And then that's been driving the returns of the index for the most part. Now, from September, I think somewhere around September, or I'll have to go look at the chart here when Doug's talking, somewhere around September till around March. So like 6-month period, semiconductors went sideways, and the whole rest of the market rotated positively. And there was a rotation going on in the market where everything else was doing well, and semis were doing nothing. They were just going flat. So for all the people who were investing in the Mag 7 and the semiconductors, they weren't doing anything while the rest of the market was doing really well. And then starting in April, semiconductors did really well. And it appears, although it's not entirely clear yet, still early, is that rotation may be rotating back out of semis and into other things. And so what you need to understand is that the markets typically rotate, and that is a healthy sign. That's a bullish sign. It's something you want to watch out for. And yes, if you're all in semis, you probably won't like it because everything else will do well and you won't. But it's a healthy sign in a healthy market, because when one thing controls the market, nothing else does, that's unhealthy. So we want to see that rotation into other sectors. And because of the war, it's a little unclear. It's really hard to predict. If we didn't have a war right now, we'd probably have a very, very healthy market right now, and it'd be going up every day. Now, it has been going up quite a bit. But if you look at the other sectors, because of the weight of technology in the markets, it drives everything. So if technology sector went down 50% right now, the whole markets would deteriorate quite significantly, regardless of what the rest of the market does. So just understand that that weight is there, and because of that weight, that will drive a lot of the returns. So if the market rotates into pretty much everything else, then that should drive the market up. And we'll see over the next few weeks. This quarter started, but as Doug's talking, I'll pull up some other charts. But it is something to note, and it's an important factor to keep in mind. Also, another another chart I wanted to share, which kind of alludes to this, is there's this concept of momentum. There's high beta versus low beta. There's a lot of different factors. People call it factoring. There's a lot of different factors. Some people call it beta. It's technical term. It's high beta versus low beta. You talk about minimum volatility versus momentum. There's a lot of similar type of factors that people look at. But the reason I want to show this is that it's really just more of the trend of, there are certain times where momentum takes off and does really well, and there's certain times where low volatility does well. As you notice in the bad times, in the times the market doesn't do as well, you want to be more in the low volatility stuff, not necessarily momentum. But if you look here, this is a 5 standard deviation overshoot, and it's just something to keep in mind. It's not good or bad. It's not that the market's going to crash. It's just something to keep an eye on. This is one of those "isn't that interesting" kind of comments. And so when you see stuff like this, it's just more of a interesting side note. Now, somebody put this together, and to me, it looks like, oh, they put it together to tell us a story. It's true. It tells a story. Oh my God, things are crazy. It's going to crash. Look, March 20, that was, things crashed after that. Don't focus so much on that. Just focus on the fact that, isn't that interesting? Just another chart. It says, isn't that interesting? Does that mean you should get out of the markets? No, it doesn't mean anything. It's just more of a aggregation of the evidence, right? Is there enough stuff? What does that mean? And is the market saying yes or no? Because I could probably deliver you 50 charts that all show the market's going to crash tomorrow. And as long as the market is strong and moving up, then none of those matter. But you're going to see a lot of charts out there that show, oh my God, it's expensive. I mean, the amount of crap I see out there, especially on X, that's just garbage and lies and BS. You have to sift through all that. You have to know you have to look at the people, you have to follow certain people and no one else, because the amount of garbage out there is just immense. So you want to try to stay away from the stories. You want to stay away from the narratives that people are delivering you, and focus more on price action. What's the price telling you? What are the different sectors telling you? Is the market rotating in a positive way, or is it just a handful of stocks doing all the heavy lifting? Things to note. So as we focus on the second half of the year, this next quarter is historically weak, and you want to be careful, because you pretty much have the 4 weakest months, some of the weakest months of the year. You got July. July is actually okay, but you have August, September, October are questionable months, so you want to be careful. July is actually not so bad. It's not terrible. It's not great, but it's okay. But you just want to be careful, because there's a lot of rocky roads ahead. There's the midterms. You've got whatever's going on in the action, military action, the war, whatever you want to call it, over in Iran, that could disrupt things. But it looks like they put a pause on it, probably to get through the midterms, would be my guess. And so Just some things to note to keep in mind. So, Doug, what's on your list of things to look at right now? What are you looking at?
Well, so a lot of new things coming in out of the holidays. I would say the theme of the week is that the market keeps looking ahead while the economy continues to look sideways. It still is acting like inflation is manageable. That the Fed is almost done with with rate decisions. AI spending continues as unchecked, even though there's tremendous headwinds and certainly more information coming out of the woodwork about how much it is costing companies to continue to invest in that infrastructure, especially the biggest names, which are, again, some of the biggest companies that are the support of the economy, of the Mag 7s. If you look underneath the covers, and it goes back to Warren Buffett saying, you don't know who's swimming naked till the tide rolls out. Well, the tide's rolling out a little bit. You're seeing that that there's a lot of nakedness there in terms of AI spending that is going to be a significant drag, potentially, on future profit reporting. And remember, markets are almost exclusively driven off profits. I mean, that's still, if you look at correlation between stock price and profit reporting, this is why it's hard to be a public company. Because you've got to constantly be making sure that Wall Street is happy with your profit reporting. And again, market keeps acting like earnings will be fine. But what the economy is saying is a little different. Jobs are continuing to slow. I'm going to tell you a personal anecdote here, Kirk. I have talked to a number of people that I know. These are not just clients, and I'm certainly talking to clients. Some of my clients, I would say, are probably at least in their, financial world doing better, not because of our advice. I'm talking about they still have jobs, they're still working. But I've talked to friends recently that I hadn't talked to in a while. I assumed, things were going really well without getting into details, got some really interesting information. It's like, hey, yeah, no, I went through this. I lost my job. My spouse lost their job. Bankruptcies was brought up in the conversation. And then they said is that when they were going to look for new jobs, and this person was fortunate to find one recently, but it was compared to their job previously, this was a there's employed and then there's underemployed, and this was an underemployed. It was a step back. And they said they were at these going and looking for jobs. The number of individuals that they were running into that were in middle to even senior management that were looking for jobs was significant. So there's definitely, I think more out there than people realize in terms of, employment, in which I'm going to get into here in a second. And then of course, one of the things that, still is a significant portion of health or financial health is housing. That's still sluggish. We continue to see some of the worst numbers we've ever seen in terms of transactions. Although ironically, I did see a data this weekend that the majority of the homes that are available in the country, when you look at it broad nation, most of them, a high percentage of them are in Florida. Florida's feeling this pinch worse than almost anywhere else. So of course it continues to be regional, but still, people are locked into either paid off homes or low interest rates. They're not overly inclined to sell, which makes a limited supply and it makes it very expensive. So it makes the buyers less interested as well. And on top of that, consumers are becoming more selective. We're seeing it. This disconnect is fascinating. So I'm going to come back to the jobs report. It was weaker, but was it? Everyone, if you followed what happened, they came out and said that there was only 57,000 jobs. Everyone immediately said the economy is slowing. They were expecting something like 111,000. Maybe. But when you look underneath, the unemployment rate actually had a little positive check. It fell because roughly 720,000 people actually left the labor force. And this is something that gets kind of blended into these employment numbers, quite often, is that, when they talk about unemployment, you have both ways. On one end, you have unemployment that might not be as bad as you think because there's people that give up and are no longer actively looking, and they get discounted in the numbers and no longer considered. And at the same time, sometimes unemployment looks worse than it actually, or jobs reports look worse than they actually say, because they include people that left the labor force. And in this case, we actually had a significant spike of people leaving the labor force. We're starting to get into greater transitional period, both from, baby boomers, kind of the end of their road, transitioning away from labor, and starting to get a bigger and bigger wave of Gen X. So this is an entirely different story. But which headline matters? Is it payrolls? Is it unemployment? Is it participation? This is why unemployment is so tricky. 1 month doesn't make a trend. Neither does one unemployment report. But here's what does concern me. The revisions. April revised lower. May revised lower. Now June has missed expectations. And the markets don't almost always focus on the newest number. And economists often focus on the revisions because the revisions tell you the direction of the economy. So the question, throwback, for us to discuss, or think about, and for those listening is, are we looking at a labor market that's weakening, or are we simply normalizing after an unusually strong spring? Now, another thing that's come up is the market is once again cheering bad news. And I find this very fascinating. Weak jobs, stock rally. Why? Because investors seem to be immediately thinking there's less chance of a Fed hike. Again, so they're constantly looking at the Fed. I don't know, Kirk, you hear this? Oh, the Fed doesn't have the influence it once did. Maybe, maybe not, but it still has a lot of influence, and a lot of stock market movement has to do with predictions on what the Fed is going to announce. That tells you the power that they still hold. If the markets are believing there's less chance of a Fed hike, that creates a weird incentive. Good news is good. Bad news then becomes good as long as it changes the Fed's expectations. And this is, in my opinion, dangerous psychology. At some point, the bad news stops meaning easier policy, and it starts meaning, as I said before, lower earnings. And that's the transition investors constantly miss. Markets love slowing growth, until the slowing growth actually hurts the profits. And where is that line? That's what everyone's trying to figure out. And that's going to be the concern going into the reopening of Wall Street after summer breaks and vacations. It's Kirk, what you were saying, volume tends to be down in the summer, which is why, it tends to be more volatile historically. Less action creates bigger moves from each action. We did come out of May, sell in May and go away, and May is typically extremely volatile. It wasn't this year. I mean, the markets are continuing to be bullish, but also I've said this, I think I said this a couple of weeks ago, with the SpaceX IPO, with the talk of OpenAI having possibly an IPO, this all depends on the case and the lawsuit with Elon Musk. These are late stage, and they're actually often late stage bearish indicators when you start to see more IPOs, because it is sometimes can be the sign of, hey, we can't get the liquidity we want, from lending, from bonds, from other sources that where we maintain all the control, and now we have to go out to Wall Street and ask Wall Street to finance us, which is something most companies never want to do. They only do it when they're looking for a liquidation event, because once they do that, Wall Street controls their business model. So these tend to be more of a bearish indicator when you start to see a spike in IPOs, and there is a number of IPOs that are listed there. Not, at least not necessarily bearish, but just late stage economy, something to be aware of. The next thing is going back to the Fed. We now have a new Fed chair. That's an uncertainty point. It's become harder to read. Kevin Warsh's first minutes came out this week or last week. It matters not because of rates, but because of communication. Powell was famous for explaining everything. And Kirk, I think you and I would both agree, sometimes ad nauseum, to the point in which it was like, okay, maybe be quiet for a minute, because he would explain something and then he'd change his mind. And at times, for a while he was consistent and, it was like, oh, he's Volcker. No, wait. Then he'd flip flop and he was Burns. Warsh has been intentionally saying less forward guidance, less signaling, and the markets now have to fear policy rather than, have to infer policy rather than being handed policy. This is going to be a big change going forward. And again, markets can't stand uncertainty. With Powell, they had certainty, and then they would get upset when he changed it. With Warsh, there's no guidance. So sometimes uncertainty actually can improve policy because the markets stop depending on every sentence from the Fed chair. But the question then becomes, does communication create healthier markets or simply more volatility? Is the market pricing the Fed we actually have, or the Fed that it wishes it had? The next thing about the market is it's broadening. This one intrigues me as well. Everyone spent 2 years talking about AI. Now, quietly, we are seeing industrials improving, financials improving. Dow continues to make new highs. Meanwhile, some technology names have paused. Oracle's doing terrible right now. This is healthier overall. This is the rotation we're talking about. Bull markets need participation. If 7 stocks continue to carry everything forever, it's fragile. If leadership broadens, that's much healthier. And the question we have to see is this a rotation that is the beginning or simply a temporary rotation? And if it's temporary, we've already started to see, for a while, it looked like it was going to be a significant rotation. Technology was starting to really, as a whole, we saw, going back about 6 months or so, technology as a whole became the laggard. Then they started to rally and they blew up again. And as you mentioned, semiconductors being a huge part of that. The question is this going to be something temporary? Is technology all of a sudden going to run everything again? Are we going to get back to the Mag 7 or a new Mag 7? Or can we have a more broad participation? But, again, back to the consumer, I think the last point of, one of the couple of last points I have is, housing, as I mentioned, still bothers me. We got stocks at record highs. The housing's still sluggish. People are locked in. Mortgage rates are elevated. Affordability is still poor. Housing touches so many things: banks, construction, furniture, lumber, appliances, employment, confidence. Historically, housing is often a leading indicator. Markets eventually follow. This time, housing's never really recovered, yet stocks have, and that disconnect deserves a ton of attention. And the question is, can we continue to call this a healthy expansion if housing continues to sit on the sidelines? Now, along with that is oil. It isn't the story it was 2 weeks ago. Everyone thought Iran would send oil to the moon. Instead, OPEC is increasing production. Oil's actually softening, and it isn't all because of the 15th agreement and end of the war. OPEC at the end of the day, production is huge. How much OPEC is releasing, although it's less influence than it used to be because, of course, America is now the #1 producer of oil in the world. But it is important because lower oil equals lower transportation costs. That's lower inflation pressure, and that's more flexibility for the Fed. So so these are all tying together. One geopolitical risk simply becomes less important. Last thing I'm going to say, liquidity versus fundamentals, and I'll hand it back to you. And I want to tie all this up and kind of, as we come back and at the end here, into something to think about in terms of allocation, but I'm going to hold that off. But my favorite macro discussion of all of this, and we have talked about this a lot over the last couple of years, liquidity versus fundamentals. M2 money supply did spike. As a matter of fact, if you look at the numbers in China, they've just been flooding the money with M2 money supply and liquidity. And M2 generally leads to, bullish for the stock market because that means there's liquidity in there to buy and to drive up, the markets. The markets are continuing to act as though this liquidity matters more than economic growth. And maybe they're right. Historically, history does say liquidity can overpower those fundamentals, but it can't go on forever. Eventually, the fundamentals do catch up. I know, Kirk, we've talked about this, and I know you're a deep value, is kind of one of your main philosophy. And it's been a long time since deep value has been something, and fundamentals have been something that really mattered in the markets. We started to see a little blip of this over the last year, finally catching up. But eventually it has to. Fundamentals matter. Quality starts to matter. You talk about venture capital, and I think you had someone on a while ago, Kirk, that was like, we don't care about fundamentals. As a matter of fact, the more you lose, the better, because it means you're investing for growth. That story has shifted hard. And I think you're starting to see now money has started to move again towards fundamentals. And the hard question on when that full rotation is going to occur is again, that it has to happen. It's just that we don't know when. We don't know if we're in it now for the longer term or this is just a blip, but it does seem like fundamentals are finally coming back into play. But the problem is, and this is something that even Warren Buffett, or now Berkshire Hathaway and their new leadership have identified, and they've lagged because of it, is, well, that's great, but if fundamentals matter, then where's the value for those fundamentals? Where do we actually find the things out there where the fundamentals are healthy, but the price is a good value to get in under those fundamentals? And that's still a challenge for finding value anywhere in this market, because everything has just been elevated in a market where the S&P 500, which is, market momentum or market cap driven, drives everything. Even if the majority, all but 490 stocks in the S&P are actually negative, all their prices they're all in the elevator together, and it's pushed them all up to questionable valuations. So back to you. I'm going to turn that over to you off a number of those thoughts.
Yeah. So one of the things you'd mentioned was the new Fed regime. And, I find it interesting that not enough people talk about this, a lot of what's going on. And, some people love Trump, some people hate Trump, based on political parties, and, they can justify it any way they want, but it's basically somewhere around political party status. But I will say this, if you kind of disconnect from the, I like him, I hate him kind of feeling, you get rid of the emotion that Trump elicits in you. If you kind of look at what he's doing, things become a lot more clear. And one of the things that he's doing that, I wish the news did their job, but one of the things he's doing is he's taking a changing, global status where, post World War II, we were effectively, the police of the world. And we effectively were moving towards globalization, right? And there are a lot of benefits to that, right? I'm not characterizing. I'm not, saying it's good or bad. I'm just saying that's what happened. Okay, forget opinions. Your opinions don't matter. This is what's happened, right? As we moved towards globalization. However, we got to such an extreme of globalization that it starts to negatively impact us, right? So yeah, we want the Chinese to compete with us, but now they're competing with us. We don't want them to compete with us, because now they're eating our lunch. And, and the Japanese did that, in the 80s, they were eating our lunch, and we didn't like that, right? So there's some benefits, but at some point, if you kind of create your own competition, well, now you're creating problems. Now you don't want that. So you got to change things up. One of the things that we were doing is we were heading more towards globalization, and it started to become a negative impact on us, right? There were a lot of negative aspects, and we started to get a lot more competitive. We started to get a little more protective. Chinese are stealing our IP. We didn't like that, and so you get in this situation where it started to reverse. Okay. And globalization was starting to reverse. And there were a lot of impacts that we were heading towards a brick wall, right? And the amount of debt we have outstanding, right? The deficit we have in our budget, these are things that are unsustainable. The fact that we're going to run out of money in Social Security and Medicare and pensions at some point, probably in the next 7 to 10 years, those are unsustainable, right? There is a point where you run out and you've got to fix it, right? So all of these problems that we have, the politicians have done a great job of kicking the can down the road. Not my problem. I won't be in office when this has happened, so I'm not going to solve it today. We'll give that to somebody else. Well, the problem is, when you do that, then the problems don't get solved and they get worse. And then you create this huge, humongous problem, right? 20 years ago, we could have solved it. Actually, like what Reagan did is he just extended the years, that you pulled Social Security. And it took like 40 years or 30 years before they actually impacted it. Okay. That's something, right? Like it or not, it was something, right? And, yet our politicians don't want to do anything because, that's somebody else's problem. And it's short-sighted and it's selfish. But regardless, it's going to impact us. One of the things that Trump is doing is he's accelerating these new trends on his own timetable. And he's creating some of the problems he's doing so that he can manage the transition. He's not saying this, unfortunately, so most people don't get it. But if you look at the globalization problem, Trump's been railing against what's been going on for a while, and we all didn't like it, but we didn't want to disrupt the apple cart, so we just didn't say anything, right? I'm saying we, I mean like the country, right? There's some people were, but most people weren't. Most people were like, well, it's doing fine, and I don't want to go to war with China, so let's just make nice. And and they know that, and they took advantage of us. And what's Trump doing is Trump is saying, yeah, I know you don't like it, but this is what's going to happen, so we're going to do it anyway, whether you like it or not, and I'm going to manage it. And that's what's happening, right? And any sort of change, people don't like. People don't like change. Well, I got to do things differently. Wait, somebody moved my cheese. Where is it now? They read that book. It was kind of a cute little book. Where do they move my cheese to? And so people don't like it because it's change, and people don't like change. So when you have these new things, people don't like it. It causes disruption. It causes volatility. Oh my God, it's Trump's fault that we have this problem. Well, no, it was a problem anyway. He just accelerated it. And I'm not saying he's not to blame. I'm just saying this is what's happening, right? You like it or not, it's just, this is what's happening. So just understand the dynamics, the mechanisms of what's going on. Now, the Fed, as Doug suggested, is the same, right? The Fed is going through a change. And Greenspan started this change when he started to tell you what was going to happen. Well, we want to raise interest rates over the next 6 months or whatever. And the markets start to say, oh, great, we can rely on this. And we know that generally the trend is up. Maybe it goes up this month, maybe not, but the trend is up, and we can play into that. Or the trend is down, we can play into that. And the market liked it because, as Doug says, it reduces volatility. And the market hates unpredictability. The market likes things that are predictable. So the Fed brought predictability in. Now, we've had that up until recently, and Warsh is going the other direction. And Warsh is talking about, well, he's not, I guess he's alluding to it a little bit, but basically what he's doing is he's bringing in a lack of transparency, saying we're not going to tell you as much of what we're going to do. Okay, I don't know if that's good or bad, honestly, because all my experience in the markets has been with the predictable part, with Greenspan, right? Greenspan and I forget how many Fed chairmen there have been in the last 25 years, but all of that has basically been, I think there's like 4 or 5, maybe 5. Anyway, but all of that to say is we're going to find out really quick what the market thinks. The market's not going to be as easy, and maybe that's a good thing. Now, we have not had a lot of quote unquote risk in the market in the recent past. When you have these sky high PEs, that's not good, right? It's not healthy. Eventually that's going to correct, and it's going to be very, very bad. And people are going to say, oh, it's because of Warsh and he did this. Maybe, or maybe just we're an unsustainable path, right? It's like Greenspan. I remember in 99 talking to some clients and prospects about interest rates. And at the time, Greenspan called it irrational exuberance. And we just call it elevated stock prices. Yeah, there you go. Thanks, Doug. Greenspan, Bernanke, Yellen, Powell, and Warsh. So 5. The nice the nice part about I forget where I was going with that. Anyway, so when you're looking at the predictable markets, what we're going to find out really quick is this going to bring about a end in the exuberant stock prices or not? Greenspan tried it. People didn't like it. People were screaming from the rafters, "Oh my God, this is crazy. He's going to destroy the stock market." I don't think it was Greenspan. I think it was just the fact that everything was expensive and eventually every party comes to an end. And that's going to happen to us at some point. I don't know when. Maybe it's after the Anthropic and OpenAI IPOs. But at some point it's going to come to an end. It doesn't feel like it's going to happen right now, but I am feeling like the AI trend is long in the tooth, but it still could go on for another few years. I don't know, but I'm certainly skeptical of it. I'm a little hesitant to, I think there's some areas of the AI trend that are probably healthier. I would not touch the LLMs. I think there's no moat whatsoever. It's a commodity, and frankly, the fact that Sam Altman's out there talking about, hey, the government should take a piece in my company. What? That is a really bad sign for investors in OpenAI, is all I got to say. When the CEO comes out and says, hey, the government should take a piece of our company, that's wrong on so many levels. But just the idea of them doing, I don't like the fact they did it in Intel, although it's in some ways they're trying to prop up U.S. production. So I get what they were doing. I don't like it as a theme, but I get what they were doing. I like the results, but I don't like the fact they're doing that at all. I don't agree with that. That's a bad trend that leads in really bad directions. However, I do think that it's an interesting trend to note, and it's probably not going to stop. And if the government takes a piece of OpenAI, I think that's a really, really bad precedent, really bad. And if the CEO is telling them to do that, it means the CEO either A, doesn't have a lot of confidence in his own company, or they're pulling the shenanigans that all big companies do. And if you don't know this game, I'm going to lay it out for you. The game is this. You start up a new industry, right? This new industry takes off, does really well. One company starts to lead, and then that company either pushes for or causes more regulation. Now, what is that? Why would they want that? You say that nobody wants regulation, but no, they do. Because what happens is when there's no regulation, that means there's a free market. It means there's competition. It means people are trying to figure things out. The market's figuring it out in the best way possible, right? In capitalism. But what happens is when big companies push for regulation, or the government pushes, from the companies through, through a lot of PR and lobbying and all that, what ends up happening is with more regulation, it cements the biggest company's position in the market. Because if you're a small company, you can't compete with them because there's regulation. The big companies, well, it's just more money. I got money to pay, so I'll just pay for this. This is what happened with the banks after the global financial crisis. Is they got overregulated. The big banks didn't care because it's just money. The small banks can't compete with that because now they got to have Sarbanes-Oxley. Now they got to have this new regulation because the mortgages. And so the smaller banks were hindered. You can't become a big bank anymore because it's too hard. It's too costly. And so big companies love regulation. See what happened with Microsoft, right? You see, every time this happens, it causes big companies to really cement their place in the playing field. So if any company that's asking for more regulation, it just means they're trying to keep out their competitors. And I'm not saying regulation's bad overall. I'm saying that big companies and people in the know, they know the game. And the game is let the government overregulate so we can cement our place and not have any new competition. It's terrible. I'm not saying regulation is terrible. I'm saying the way they use it is terrible, and the way that the big companies and the government play this game does not benefit you as a consumer. So just keep that in mind. When the crypto industry is talking about we need more regulation, that always scares me when I hear that. Not saying it's good or bad, but I know when the banks are telling me, "Whoa, we got to keep out the the money laundering." Really? What is the number one tool for money laundering? The US dollar. Okay, it's not crypto, it's the dollar. And from what I hear, and I'm not saying any names, another tool is the US banking system. Just saying. I heard that in the grapevine. So if you want to talk about things that reduce money laundering, how about you do your job with the banks and the US dollar is another one, right? So, when you hear these things, there's usually other motives behind it, and they're usually not what you think they are. So it gets people's emotions up. Oh, we got to protect, we got to keep out the money laundering. No, you're not. You're not. It's happening whether you like it or not. And it has nothing to do with crypto. Crypto is not the biggest source of money laundering, not even close.
Hey, Kirk,
Go ahead, Doug.
when you travel on an airplane, do they tell you can't bring more than 10,000 in crypto into the United States?
No, they don't.
They do not.
They do not. Yeah. So to Doug's point, I like your sense of humor, Doug. But that's the truth of it, right? Is that it's not what you think it is. What you hear in the media is usually BS, and it's usually to a point. So we'll see what happens. The government can't seem to find their own feet. They can't seem to pass a what was it actually that act? Was it you needed to have an ID or you need to be a citizen, or I forget what it was, but whatever it was, they couldn't pass it, even though 80+% of the public was for it. They still couldn't pass it. They can't pass the crypto regulation. I don't know what they're doing. Maybe they're waiting for the
SAVE
election.
Act.
The SAVE Act, yeah. Maybe they're waiting for the elections. But either way, Doug, final thoughts from you before we wrap it up.
Yeah, a couple thoughts. I wanted to summarize. I said I'd come back to this. A reminder that with so much going on right now, in so many different directions, and the lack of clarity, we clearly have a question around inflation and where inflation could potentially go. Is it going to finally are they going to be able to control it? Is it going to be in check? Is it going to stay low, or is it going to continue to increase? The fact that we still have the markets just absolutely rocking, firing on all cylinders right now, at least on the surface level. The markets just keep going up. But the fact that we also have, since 2023, a lot more questions with what's going on with the Fed and decisions that they're making around rates more than we've seen in the past couple of decades. And then obviously the impact of what this means in terms of, where you're going to get dividends, precious metal, et cetera. I want to remind people that this is a time to really consider, again, the asset classes that you hold in your portfolio, and that there is no such thing as the one true asset class, although there'd be plenty of discussion out there around just buy the S&P 500, according to Warren Buffett and everybody on FinTwit. But the reality of it is that we've seen just over the last 12 months that is not the only asset class that actually does perform. And for those that love to tout averages, 12%, whatever average S&P 500, none of that matters when it comes to when you need your money. Sequence of returns have a much greater impact to your own situation than averages. And we went 13 years between 2000 and 2013 where the S&P 500 was flat to negative. In fact, it didn't get above a 5% average return from 2000 until 2018. Most of the growth of the S&P 500 has been since 2018, exacerbated by the M2 money injection from COVID. So it's great, these averages, but if you were withdrawing from your portfolios during that period from 2000 to 2013, to 2018, you have a very different look on on what's remaining. And if we go back to this 1968 to 1982, the market, the S&P 500 averaged under 1% a year for that period. So depending on when you need the money matters. So I want to throw something out there, Kirk, and it's not necessarily following this exactly, but in a way, kind of what, your portfolio model, and many portfolio models are kind of following something that is known as the permanent portfolio. And I'm not saying you can address that. But when we think about what's going on right now, it's actually experiencing a major validation period as this rotation unfolds. It's explicitly been built to eliminate macroeconomic guesswork by maintaining parts that include stocks, long-term treasuries, cash, and gold. Now, certainly question long-term treasuries, but if you're going to hold them to fruition, long-term treasuries do pay a nice yield. If you're trying to trade them, it's a very dangerous place to be with where the Fed's going to go. But short-term treasuries could be an alternate in the time frame, because again, those are going to be more directly tied to what the Fed decides to do. We're seeing the metals catalyst. Gold remains supported by structural factors. Global debt load exceeds 353 trillion. Aggressive central bank diversification away from fiat paper is fueling long-term debasement trade. Again, that's where the metals come into play. Again, this is a long-term thought. Treasury yield shift. The fixed income quadrant is experiencing intense volatility. 10-year treasury yields pushed to 4.55%, following tight payroll data. That dynamic gives short-term cash, T-bill quadrant, massive relative utility for yield, while option markets are heavily betting on a drop back toward 4.4%. Then there's equity de-risking. With Wall Street grappling with this high AI tech sector valuations and rising bond yields, equities are facing a headwind. That construction of having those different asset classes, and not necessarily saying you should do the 25% each, but again, the reminder that cash is an asset class, and that bonds or fixed income is an asset class, that precious metals is an asset class. By having that diversification to some degree, that slice captures upside when growth rallies, but it also its absolute exposure gets strictly capped based on those breakdowns. So again, this is a time to maybe, if you start to look at where things lay and your own portfolios, it's maybe a good time to start thinking beyond beyond just having, this equity ownership. I think we're at a very different spot that's in play right now in terms of where things are going to go. So I want to wrap this up as we wind down. And I'd like to leave you with something that has nothing to do with the headlines. Okay. As I talk about that diversification, as I talk about understanding that cash can be your friend, as I talk about the fact that, the stocks are not necessarily the only place to hold. This has nothing to do with the Fed. It has nothing to do with AI. It has nothing to do with the markets. It has everything to do with you. And if you've been listening to this show for a while, I'm guessing you're not someone who's looking for a shortcut. You've been listening to a lot of things we've talked about, and a lot of things Kirk and I talk about are not shortcut decisions. Okay. You've probably the kind of person that spent decades trying to make good financial decisions. You've built a career. You've probably saved consistently. You've raised a family. You've sacrificed, and you've done what you believe are the right things. And after nearly 20 years of sitting across the table from families, have learned something. The people who worry the most about their financial future usually aren't the ones who are in trouble. They're the ones who care enough to ask better questions, like, can I really retire when I think I can? If something happens to me, will the people I love truly be okay? Am I paying for college the smartest way possible, or just the way everyone else does it? Will taxes quietly become one of my biggest expenses over the next 20 years? Or have I built a retirement income strategy, or have I just simply accumulated retirement accounts? And maybe the question that ties them all together, do I actually know, or do I just hope? Because knowing and hoping, they're very different things. So let me ask you another question. How many different professionals touch your financial life today? Maybe you've got an investment advisor, or CPA, an attorney, insurance agent, HR, maybe someone helping with college. And ask yourself, who's responsible for making sure all those pieces actually work together? Because here's what we found. Most people don't have bad financial plans. They have good financial pieces that have never been connected. And that's where opportunities are missed. Not because someone gave bad advice, because no one stepped back to look at the whole picture. Maybe your investment strategy is excellent, but does it support your tax strategy? Does your tax strategy support your estate plan? Does your estate plan support how you're paying for college? Does your insurance support your retirement income plan? Or does it help you with college if something unexpected happens? Or are these decisions being made all independently, hoping for some that they will somehow fit together? And here's the question I always come back to. If there were one blind spot that could quietly cost your family hundreds of thousands of dollars over the next 20 years, would you rather discover it today or after you've retired or 20 years in when you need things to work the most efficiently? Families we work with don't come to us because they failed. They come because they've succeeded. And they've reached a point where too much is riding on assumptions. Successful people don't seek second opinions because they're unsure of themselves. They seek those second opinions because the stakes are simply too high to assume everything is working exactly the way they think it is. And that's why at our firm, Mergent Advisors, before we recommend anything, we map everything: your income, assets, liabilities, taxes, retirement, estate planning, college. And we have a conversation around it. Not because we expect everything to be wrong, because we refuse to assume that everything is right. Sometimes the biggest opportunity isn't earning another 1%. It's finding the one blind spot that could cost you 20. So if you've been listening today and one question has been coming back in your mind, I think I'm doing okay, but how do I really know? Maybe that's your answer. Not that something is wrong, but something this important deserves clarity. Visit us at mergentadvisors.net, MERGENT, mergentadvisors.net, because hope is not a financial strategy. Confidence is. And confidence comes from knowing, not wondering. And the greatest return on investment is not an extra percentage point. It's the confidence to enjoy the life that you've spent decades building. Thanks, Kirk.
Yeah, thanks, Doug. And I wanted to share, I pulled the chart up before we wrap it up here, but I wanted to share, this was the year-to-date performance of all the stocks in the S&P 500. And, what you'll notice here is things have done really well are the semiconductors. The things that have not done well is software. And, if you look at certain medical devices have not done well, then you look at some of the Mag 7, Meta, Tesla are down. Microsoft's down. Oracle's not one of them. Palantir's not one of them, but they're down big. But you got NVIDIA, you got Google up a little bit, you got Amazon up a little bit, not a lot, just a little bit. So you see this is the first half of the year, right? Now, if you look at the last quarter, if you look at the last quarter, wow, everything looks great. But if you look at the year, not so hot. And this is because of the war, right? If you look at the last 3 months, April, May, and June, April is when is the bottom of the market. April 1st or 2nd was the bottom, and it's gone up since. So obviously this has done well, but you notice these areas haven't done so hot, right? Consumer like Walmart, ExxonMobil, Chevron, obviously because the end of the war, those stocks have come down in price. But if you look at consumer, Costco, Walmart, not done so hot, right? You look at Netflix, not done so hot. Most things have done well, to be fair. But just keep that in mind that if you look for the year, not everything's doing well. But you do want to look for the areas that are doing well. Industrials are doing great. Semiconductors are doing great. Certain areas of technology are doing great. And certain parts of healthcare are doing pretty well, surprisingly. They're actually making a comeback. We don't talk about small caps enough, but they're actually doing well. So just things to keep in mind. I did want to mention one more thing. We'll wrap it up. Is gold miners, as gold and precious metals have not been doing well. But I've seen these charts, and these are interesting to note. This one here is called the Gold Miner Bullish Percent Index. You don't really have to know much about it other than the fact that it's a data point. So when you see that 100% are bullish, as it was in February, that's a bad sign, right? Is that when things are that high. But it's also a good sign when things hit zero or close to zero, like they did in the last few weeks. Right now, it's about a quarter, about 24.66%. But it's just important to note, just because the sector is not done being sold off, I don't think, but we're actually at a place where a lot of people are like, you know what, I'm buying. And these are smart people that I respect, and they're starting to buy, and that's great. I think the reason that gold's going down is because central banks are selling it because of the war, and they need access to capital, and they don't, they can't sell, so they're selling their gold. Not all countries, but some are. So, gold's one of those things where it'll eventually come back, but at the moment, it's not getting a lot of support. So I don't think it'll go much lower. So if people want to buy, it's a good time to start thinking about it. I wouldn't go all in, but it's certainly something to think about. This one here on miners, just wanted to point this out because this is basically gold miners compared to the S&P, and we're talking about free cash flow yield differential. Now, basically what this means is when it's positive, it means miners are cheap. Now, this was, I don't think this has recent numbers. This was before the war, I assume, because basically miners make money when oil prices are low. That's their input, and the precious metals price is high. That's their output. Input, output. You have expense, you have income. When your expense is low, meaning low oil prices, that's great. When you have high precious metals prices, that's your output that's high. That's when you make your most profit, and that's what we saw here. And oddly enough, I don't think a lot of people realize this, but if you look at oil prices before the war, oil prices were right around $66. As of today, $68.80. We are really close to where we were before the war started. I went to fill up my gas pump. I went to fill up my gas this weekend, and it was $4 a gallon. WTF? It was $2.50 before the war, and now it's $4. Trump came out and made some comment about gouging from the from the gas pumps. I've not looked into why this is still the case, but I know somewhat the reason. But come on, guys, this is ridiculous. It doesn't need to be that high. But anyway, the point being is it's still at the gas pump, which means it's still impacting consumers, and it's still impacting companies, because that's the price they're getting to drive trucks and what have you. So just something to keep in mind, that's still going on. And until the gas prices come down, that's all that really matters. Doesn't matter what oil is. Really what matters is gas prices, because that's what we use every day. Anyway, so we're going to wrap it up here, and we'll see you all on Friday. So that's the show for this week. Thanks again for joining us. Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and podcast app you're choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.